Ruskin with us at Deutsche Bank. Lots to talk about, and great to jump in. This Rogoff, I thought, with a terrific op-ed today in the FT. I've got a couple comments from Rogoff. Let's look at this one first. You can see it down here. Alan, if the Eurozone ultimately becomes unglued, will anyone care that during the Euro's brief life, inflation expectations remain firmly anchored about 2%? I thought just a great comment about what L. Arian talks about, focus on what matters. What matters right now for European elites?
Well, ideally to hold the euro together. I think the euro area can deal in a worst-case scenario with a default, and a default sets up precedents for defaults. But as soon as you start having currencies exiting the euro, you've got some big problems on your hands. Then I think you're setting up the precedent for exits, and who knows, if Greece were to exit, for example, which country follows? And the market would certainly push in that direction. So at the moment, you're just trying to glue the system together. But I have to say, I mean, this is a little bit of a Band-Aid that we're putting on the system in a sense. It's still quite hard to look, say, 5 years hence and see proper convergence in both the real economies between the periphery and the core and the financial sector. So bond markets in Italy, are they diverging or converging with Germany in 5 years' time?
I like how you mentioned the word convergence here as a theme. I think of Barry Eichengreen writing about that for years. Did we ever have convergence in the euro? Or was it just the illusion of 200 beeps of nominal GDP making everybody feel good?
No, I think it was an illusion. I think this is exactly the problem. We had some convergence, obviously, at the short end of the curve. We thought we had convergence at the long end of the curve. But I think when you looked at real interest rates, you actually found that policy was way, way too easy for the periphery for a protracted period of time. And now it's just flipped on its head, really. Policy's way, way too tight for the periphery. And probably at this point in time, perhaps even a little too easy for Germany.
Right. Well, I was going to get right to that. Let's look at this chart, folks. This just thunderstruck me this morning. I'll be honest, I've never looked at this. It's just Eurozone GDP. All this angst. It's not a bad chart, but the answer is it's just the divergence of these peripherals, or even Italy and Spain, from a relative juggernaut like Germany. It's just remarkable, the separation here.
Absolutely. And I guess the question is, can this continue? And the earlier question you had as to next year, for example, what is the growth outlook? Pretty much everybody's scaling back their growth outlook on not just the periphery, of course,
right,
but the core in particular.
Your colleague, Thomas Meyer, and I was privileged to do a panel at the IMF with Dr. Meyer here at the meetings with Carlo Cottarelli. He has been so prescient, as is Charles Dumas, about this idea of Euro struggle, just the philosophical struggle of their political economics. I go, again, back to how do we clear the markets? Is it a bank recapitalization? And without getting into the sensitivities of you working with Deutsche Bank, how do you perceive a recapitalization to occur?
The recapitalization could easily occur through the EFSF for at least the periphery countries. Logically, you wouldn't take money from the EFSF to recapitalize, say, a French bank. It would be that, really taking from Paul to pay Paul, in a sense, since France is such an integral part of the EFSF in terms of financing. So I think for the periphery countries, you're looking at really the EFSF as the natural vehicle. But for some of the bigger countries, I think they're really going to have to finance that from their own treasury. And then I think the big question is, does it have ratings implications, really?